Good evening, everybody. I'm Kurt Wilson, Mayor of Roswell, and I'd like to call the 2023 budget process, budget work session, this meeting to order. I'd like to introduce to my left, Councilmember Hall, Councilmember Palermo, Councilmember Vanstrom, Councilmember Hills, Councilmember Morthland, all in attendance. There's an excused absence for Councilman Member Zapata. I'd like to thank our Finance Director, Ryan Luckett, for being with us. Of course, our City Administrator, Mr. Randy Knighton, thank you for being with us, sir. Our City Clerk, Marley Press, and I'm having a short brain lesion where I've forgotten our very valuable Mr. Petty, our City Assistant Attorney, with us. And we have a very special guest from First Trine Advisors, David Cheatwood, the Managing Director, is here with us to give us a presentation. So with that, I'd like to introduce Mr. Luckett, our Finance Director, and to take over.
Thank you, Mayor. Good afternoon, everyone. We're here this afternoon to discuss with you some information about funding capital projects. And as the Mayor mentioned, we have David Cheatwood here with First Trine Advisory Firm. They are the financial advisors for the city. And Mr. Cheatwood is going to present some information to give you an overview of the city's financial position and some information about capital funding. Once he's done, I'm going to have a few closing comments, and then we can open it up for questions. And of course, if you have questions in the middle, please feel free to ask those as well. So with that, I'll turn it over to David, and we'll get started.
Good afternoon, everybody. Thanks very much for having me here this afternoon. My name's David Cheatwood. I work at a firm called First Trine Advisors. We have served as the city's financial advisor since 2019. So we work with cities, counties, utility systems, school districts across the Carolinas and Georgia, and we work with them on long-term financial capital planning and on really shepherding you through any sort of bond or debt issuance process. As Ryan said, I'm here to talk a little bit about capital funding options as y'all consider some projects on the horizon. And before we get into that, really talk about kind of where y'all stand right now financially, looking at your outstanding debt, your credit ratings, and then get into some of the different financial metrics that you all have. I always like to start out with outstanding debt, just to give you a feel for how much you have out there now, what's your starting point as you consider potentially funding new projects with debt. A lot of numbers on this page. I promise it gets a little bit clearer going forward. But in total, you all have about $35 million in outstanding debt. That's broken down, or we've broken it down between two kind of big groupings here, what we call the primary government and then your enterprise or business type. Your business type is going to be your water and sewer and your solid waste. You have one loan outstanding for each of those funds there through GFA. And then you have on your primary government side, you have several different ones out there. Your biggest ones are going to be your general obligation bonds, and that'll be something we talk about in terms of future funding options for you. You have two series of general obligation bonds dating back to your 2012 bond referendum. Between the two of them, you have about $3.6 million outstanding. And then you have several other types of agreements in relatively smaller outstanding amounts. A lot of capital leases for fire trucks, ladder trucks, equipment out there as well. And then you have, as I mentioned, you've got a solid waste transfer station down here for $3 million that is getting ready to come up. And so that's just a picture of your outstanding debt. One thing we do as your financial advisor, we look at your outstanding debt to see if there's any refinancing opportunities that are out there. And I'll point you to a couple of things. I don't know if I have it on here, but in terms of your average interest rate on your outstanding debt on the primary government side, it's 1.73%. And then on your business side, your enterprise systems, 1.24%. So your blended overall debt profile, an incredibly low 1.52% interest rate across all of those different loans. And that's because you've, fortunate to have enter the market at low interest rate periods, but also because you've actively managed it, you've refinanced some of this outstanding debt from time to time. We've highlighted these couple of capital leases that we worked with Ryan on a few years back to modify that interest rate lower. And so again, that's something that we're looking at as your financial advisor if there are any refinancing opportunities. But given what you've done out there and you've been able to access the different state loan programs really well that have low interest rates, you don't have any other refinancing opportunities right now. You've taken advantage of what's out there, so that's good. This is a picture of while this was your outstanding principal amount, the amount that you owe in terms of the par amount or principal amount outstanding, you owe principal plus interest. And so this is a picture of what your debt service, principal plus interest, looks like over time. What I'll point you to on the governmental side is you'll see a pretty big drop off over the next couple of years in your outstanding debt service, and that's primarily due to your general obligation bonds that start to roll off in 2023 and then in 2024. So as that debt starts to get paid off, your total debt outstanding goes down, which means you have some capacity to layer on new debt and mitigating the impact there. Your business type, that solid waste and water and sewer, which we've combined here, principal and interest, a very low $1 million per year in the aggregate. Those are fairly newer loans, so they stretch out a little bit longer. One thing I wanted to touch on, because we'll get to this when we talk about funding options, general obligation bonds. And so you repay that debt with a separate millage on your tax bill. That's your debt service millage rate. Historically, you've been at $0.25. You've been levying that to pay your GO debt. With $1 million equating to about $5.7 million of revenue, that $0.25 was generating around 1.65 or so million per year. And with your outstanding debt on those 2013 and 2014 GO bonds, they go out, as I mentioned, until 2024. You have a step down in your debt service over the next, in 2024 from where it's at right now. So you all actually lowered your debt service millage levy from 0.25 to 0.1. And the reason you did that is because over time you had built up a little bit of a balance. If you look in that far right-hand column, fiscal year ending 2021, June 30, 2021, you had just under $2.3 million in that debt service fund balance. And that's pretty natural to have. As you levy that 0.25 mil, naturally you tend to collect a little bit more than you need each year. And so you built up some fund balance there. And so what you all elected to do was to essentially lower your millage and then utilize that debt service fund balance, which has to go to pay debt service on GO bonds. And so with the 0.1 mils that you'll levy, you'll then use that debt service fund balance, about $1 million or 1.1 million in fiscal 22 and fiscal 23. And that's the combination of the 0.1 mils and your debt service fund balance are going to allow you to pay off your Series 2013 and 2014 bonds. So I wanted to kind of cover this debt service millage because at the end, again, on funding options, I have an example for you of if you levied a certain amount, how much could you borrow based on current market rates. So in addition to debt, I want to set the stage kind of where you are from a credit rating perspective. And so there's three major credit ratings out there: Moody's, Standard & Poor's, and Fitch. The city is rated by two of those three, which you're rated by Moody's and Standard & Poor's. That's pretty natural. Not everybody has all three ratings, and so normally Fitch is the third of the three that you get, but a lot of them have just the two, Moody's and Standard & Poor's. And you all are rated AAA by both of those entities, and that, as highlighted, that's the highest rating you can have, and that's on your general obligation bonds out there. Those ratings are tied to your Series 2013 and Series 2014 general obligation bonds. I've summarized some of the strengths that they've noted in their last rating reports, things like really sizable tax base, strong income levels, ample reserves, formal fiscal policies, manageable debt burden, strong economy. Normally with AAAs, they have a little trouble coming up with any sort of weaknesses or challenges, but they've noted economically sensitive sales tax that's out there. That's really for everybody. Things that could lead to an upgrade, nothing, because you're already at the top. Things that could lead to a downgrade if you draw down your reserves. That's something you'll see in a second is a really big factor. and kind of an imbalance in your budget cycle if you're using your fund balance to pay for operating expenses year in and year out. But y'all are in an incredibly strong credit rating position, and this has a direct impact on any sort of interest rate you'd have with the borrowing. And so the higher you are from a credit rating perspective, the lower your interest rate will be. I just wanted to highlight a couple things so you can kind of keep in the back of your head when we talk about credit ratings. What are they looking at? What sort of factors are these agencies looking at here? I've got Moody's and Standard & Poor's. They have them in slightly different buckets, but they're generally looking at the same factors. A big piece of it, 30% of your overall credit rating, is driven by the local economy and tax base. They're simply looking at what is the size of your tax base. Full value per capita is a ratio they look at from Moody's, and then income levels, wealth levels. Moody's looks at median family income. Standard & Poor's looks at per capita income. So those are 30%. Those factors make up 30% of a rating. Your finances make up 30%. And the finances is really focused on fund balance and cash balance. They look at the spot amount, and then they look at a trend over time. Are you building that up? Are you drawing it down? And so that's, in a nutshell, fund balance and cash balance is what they're focused on the financial front. They also look at management. That institutional framework is really an entity's relationship with the state. Does the state control certain revenues? What's the interplay there? And then operating history is your performance to your budget. Are you generating a surplus each year, a deficit? How closely are you tracking there? And then lastly, debt and pensions, 20% of your overall credit rating. 10% is tied to debt, and then 10% is tied to pensions there. And so when we look at things like, and I'll talk about a model that we have with the city out there, but issuing new debt, is that going to impact our credit rating? You'll see it's only 10% of your overall rating is tied to debt, so it tends to not move the needle as much as one may think it would if you go and issue debt out there. These bigger categories are the ones that are the factors that can really move a credit rating. And I'll quickly hit on S&P, very similar criteria. They're looking at the economy, a couple of different metrics out there. That's worth 30%. Financial, also worth 30%. A couple of different metrics, but primarily fund balance, management, and then the debt is 10% there as well. So just to give you an idea, when we look at potentially funding projects or issuing debt, a lot of times the question will come up, well, we have a lot of cash. What if we use all of our cash to fund these projects? We may say, well, you can do that, but keep in mind your credit rating may go down because the fund balance is one of the main things they look at. Flip side is if you go and issue debt for everything, is there sensitivity with those debt metrics to potentially causing a lower credit rating? Not to say that credit rating alone is a driver of any decision, but it's certainly one of the things you want to keep in mind when you're deciding how to fund projects. Switching over now to your specific financials and financial performance over time, we've broken this down a couple of different ways, looking at some of the financial metrics and also some of the debt metrics that are out there. We start our analysis of this with a trend analysis, so a 5-year look back over time. So we have your fiscal 2017 through your fiscal 2021 figures up there, and then we've given you a comparison of where you are versus Georgia median levels there for all AAA rated cities in the count, cities in the state within a certain population range, and the same thing for national medians for all AAAs out there, just to give you an idea to how you stack up. One thing I should note, this is all coming from Moody's, one of the main rating agencies that I just talked about. They have a lot of data out there. We have a direct feed into their system, so it can pull all of their data in. From a financial performance metric, we're looking at a couple things. Again, fund balance is the biggest one, and what are your trends? And what I'll point you to, and I'll kind of focus on unassigned fund balance, that has really jumped up over the last couple years. I would ignore 17 and 18 on your unassigned fund balance because y'all kept that in a different, you didn't keep it in unassigned, you kept it somewhere else. But if you really focus on 2019, 20, and 21, you've seen your dollar amount grow. Your percentage has grown a little bit with that as well. And you'll see compared to some of the AAA medians out there, whether that's the state or nation, you're really right in line with those from an unassigned fund balance perspective. And that's obviously the trend you want to see there. What we've also done is given you some specific peer comps. And so we've looked across the state and we've pulled peers, cities and towns with a population from 50,000 to 150,000 that are either rated AAA or AA1, which is the next highest. So the top two rating categories with that population range in the state, how do you stack up in terms of total fund balance? Total fund balance around 37%. You'll see that, from a total fund balance perspective, a little bit on the lower end to some of the other AAAs in that peer group across the state. Unassigned fund balance, I'd say kind of right in the middle range there. A handful are higher, a couple are lower there. But again, this is just this peer comp list of the 50,000 to 150,000 that have a AAA or AA1 from Moody's. And this is something I would say, credit rating agencies, they look at those specific factors, but then they also compare you to peers, because sometimes their ratios may be a little bit out of whack, but let me kind of compare you to some other entities that are out there. And this is also good in settings like this when you're saying, how do I fund certain projects? What if I draw down my fund balance? You may be interested to know kind of who else, what are other entities across the state doing in terms of fund balance out there? Do I have too much? Do I have too little? This provides you another data point. And I should have said at the outset, feel free to interrupt me along the way with any sort of questions here as I go. Looking at debt. Oh yeah, sorry.
On that opening, could you go back to that slide, or the fund balance slide, and could you perhaps explain to us in Brookhaven, so they have a difference of 60% to 37%. What would that piece, what would be examples that might cause that difference?
So they, in terms of, are you asking why is there 60%, like the difference between total fund balance and unassigned fund balance, or why they may just have more than Roswell?
Why do they have more than Roswell in that? And then also if you can talk about unassigned fund balance as well.
The difference again between total fund balance, unassigned fund balance. Unassigned is truly you've got no specific use for it. That's your savings account. Total fund balance looks at things like assigned fund balance, committed fund balance. You have set money aside, it's there, but you've targeted a specific project or use for that. So that's the difference between the two. And so someone like Brookhaven, and we don't work with Brookhaven, so I'm not sure, but this could just be they have a policy, they feel comfortable with a higher amount. Maybe they've just had a couple of really good years in a row and it's just built up and they haven't decided what to do with it yet. So I can't speak specifically as to why it's that high, but it's pretty typical if you look across the other states as well. You're going to have these ones that just have a higher balance, and I think that's because the city's growing, tax base is growing, they may be getting in more funds, and they don't have specific projects identified yet to put that towards, and so those funds start to grow. The other thing I should have mentioned too, some of this data is from fiscal 2020 for the other entities. As y'all know, a lot of people are finishing up their fiscal 21 audits, so not all of this is a comparison of 2021 audits to your 2021 audit. So I want to note that. That's something we update as we get in the information, and I can't speak to Brookhaven if theirs is 21 or 20 data. So I don't have a great answer for you in that one specifically, other than some entities just start to build it up and they don't have a specific use for it yet. Yes, sir.
Since we're talking about this, what percentage do you like to call healthy? Where do we need to be on health?
So that question comes up a lot. What's a minimum level that you have out there? And y'all have a fund balance policy that is 25%. And so I don't want to say that my answer was already determined, but I would tell you 25% is a good minimum level. When we look at the rating agencies, which is a point I always start with, again, that doesn't have to dictate it, but for Moody's specifically, if you have more than 30% in terms of your fund balance, you're getting the highest mark for that metric. And so that'll give you some idea. 30% in their mind is the top, you're getting the top marks. S&P, it's actually, it's either 15 or 20%. It's a lower balance. So that minimum fund balance of 25% is a really good level to have as a minimum. I think it's great to have a little bit more. Again, just gives you some cushion there, like y'all have, a little bit more than 30%. But that 25% is normally the answer I'd give in terms of what's a minimum level you want to target if you want to be a high credit quality entity. A lot of others may say, again, under the theory of credit ratings don't drive the interest rate, credit ratings are not the be-all, end-all. They may be more comfortable with 15 or 20%. I'd say most of the highly rated entities, and the proof is here, are in that 25 to 30% range. From a debt side, a debt metric side, so there's a couple of different debt metrics that we look at. Debt as a percentage of full value, debt as a percentage of your market value, and then debt per capita. And this is a metric that really sticks out to me in a good way for Roswell. You'll see your debt metric, debt as a percent of full value, 0.12% in 2021, and debt per capita, $191. Compare yourself to those Georgia AAA, the median out there, as well as the national AAA median, much, much higher than you all. So you all have an extremely low debt ratio or debt ratios. If you look at this again to that same population mix, 50 to 100,000, the same peer group out there, incredibly low, lower than all your peers across the state on both of those. And that really goes back to that first page we looked at. Outside of those two general obligation bonds, you have a couple of smaller loans out there, but a really low starting point from a debt metric side. So that means, again, you can layer on new debt and still be very much in line with your peers across the state and nation. In terms of some of the kind of economic metrics out there, the median family income, and then the total full value or market value that's out there, you'll see from a market value standpoint, that $15 billion out there, very much in line with the Georgia median for AAAs, as well as the national. Actually, you're higher than the national. And then your median family income is very high as well, 157% of the national average, pretty much in line with the other AAAs in Georgia and the nation there. So good, and that's really what, going back to the strengths that were noted from the rating agencies, that tax base size, those wealth levels, are really positives in your favor there. This is, you would expect to see this, again, looking at other AAAs, given that the local economy and those metrics are 30% of a credit rating, you would expect to see the other AAAs out there be pretty comparable to y'all in terms of those couple of metrics, total full value or market value, and then market value per capita. Y'all are right in line for the most part with those other peers out there. Let me pause for a second because, again, wanted to start with existing debt, existing credit, and then some of the financial trends and your comparisons to other peers. Any questions? Any other questions on that?
Could you go back one slide and go back and describe for us full value per capita, and then go back and then come forward back to the slide where you showed it in comparison to our sister cities?
Right.
Would you just give us a little greater, a more elaborate description here?
Sure. So total full value, also just market value of all the property in your area. And so you all, again, this is all coming from Moody's, 15.5 billion, this is in thousands, so 15.5 billion market value. And that's grown over time as your tax base has grown and as it's grown in value. If you look at kind of where you are compared to the Georgia median for AAAs, right in line with those, and then same, you're actually higher on the national median side. Then full value per capita is just looking at your total full value and dividing it by your population. So kind of taking it down to a per person level, per capita level. What does that mean in terms of market value per person? It's just a metric out there. So if you had a really big tax base with a small population, that's going to say your small population has some really expensive properties out there, so your full value per capita is going to be higher. If you had a big full value, the same full value per capita full value that you have, but twice the number of people, then it's going to be smaller kind of value parcels.
So can you pull forward one slide? And I think it's just instructive for us, council, if you look at this and you look at the full value per capita, and you can see the comparison to Alpharetta, Sandy Springs, Milton, even Johns Creek. We're right there with Johns Creek, but you can see our sister city of Milton, Sandy Springs and Alpharetta, their full value per capita is significantly higher.
These are, this peer group.
And that goes back to property values and
Right.
how many people are actually property owners that have property in your city,
Right.
and those who do not. And that is a factor in this particular metric. And I don't know if people really understand that. So you look at this, kind of goes back to much of the discussion we have in our city, which is tied into this, is the affordable housing discussion, and how Roswell is already a significant participant in the affordable housing discussion, as this demonstrated by this particular statistic, when basically most of our residents don't recognize that 65% of our homes are single family and 35% are rental. And where that manifests itself is right here. That's why I wanted to kind of stop on this so you can see this metric from a quantitative perspective, that there is a consequence to that. When you look at it from a standpoint of being an aspirational community and the value that does deem itself from an aggregate perspective. So I wanted to just point this out so that everybody this is a real metric where that ties in. Sorry to interrupt.
No, that's great. So what I would summarize what we've been through here before we get into some different types of financing options or funding options. Very low debt level, very high credit rating, and very strong financial history and position. So that's kind of the starting point of where you all are, a very enviable position when you're talking about funding new projects going forward. So on that note, let's talk about how you fund new projects. The two to three main ways: cash, debt, or grants, third-party sources that are out there, which can be grouped into cash as well. But from a cash standpoint, these are going to be your fund balances, what you have on hand in your different funds. We've given you an idea. This is all pulled straight from your audit for fiscal year end 2021, the different funds that you have out there and the cash balances of each of those. You may look at that right out of the gate and say, that's a ton of cash. Great, we can do pay-go for everything we want to do. Well, I would note a lot of these are restricted funds. The T-SPOS fund, clearly that can only go to road improvement projects, so that's going to be earmarked for those. The debt service fund that we talked about earlier when we were talking about your debt service millage, that $2.2 million, that has to go to pay debt service on your GO bonds, and that's your plan to use that money, to draw down that money to pay that, since you lowered your millage from 0.25 to 0.1. And then some of the impact fee funds, water and sewer has to go to water and sewer. So a lot of those are really specific projects. Yes, sir.
Thank you. And even with this, so looking at just the general fund, and so this would be as of June 30th of 2021, it's that 32 million might be misleading. That doesn't mean just the city has $32 million of cash that it could go spend, but that 32 million would be covered a lot probably by the 25% requirement.
Exactly. That 32 million is exactly what we're talking about, where you have 32% of your fund balance is unassigned. That's what that is. And so there's not a lot of room over your minimum of 25%.
Thank you.
You've got about 5 to 7 million maybe above that. And that's one of those things that I talked about. If you say, well, hey, let's spend some of that down, sure you can, but it does have an impact on credit rating too. And so you can't have one without the other. But just wanted to give you a picture of all of that, which it looks great. You're in great position, but it's not like you can go and spend all of that on different projects coming up. So outside of cash, you have grants, and so there is a lot of grants or third-party funding that's out there. I know Ryan's going to talk about later the American Rescue Plan funding and what you have on that side, if there's any state money. But this is a period of time over the last year or so where there's a lot of federal money out there, and so certainly if you can get your hands on any of that, and the city's gotten some, that's a great place to start with funding projects. You can do things like private funding or public-private partnerships as well. And then debt. And I want to focus on the debt side as over the next couple slides, because there's some different types of financing structures out there for you to consider. So, on debt, in Georgia, there's a number of different financing structures you can issue debt under. The first is general obligation bonds, and I'm going to go through each of these in a little bit more detail. But you have general obligation bonds, what we would call intergovernmental revenue bonds or intergovernmental contract revenue bonds. You have just straight up revenue bonds like water and sewer or solid waste, a specific revenue stream. You have this category, lease purchases, certificates of participation, installment, sale agreements. I've lumped all those together because they really don't fit in any other bucket. You're normally giving a security interest or a lien on the asset you're financing. You're not pledging a specific security. The debt service may be subject to appropriation each year, so it's kind of its own little bucket there. And then you have tax allocation bonds. It can be similar. Those are a revenue bond as well because it's tax increment that's generated in a specific area you can pledge. So at a really high level, those are the different financing structures available to you in Georgia. So taking each of these in turn, general obligation bonds, those are secured by the full faith, credit, and taxing power of the city. So very straightforward. It is the easiest type of bond to sell. It's the most credit-worthy that's out there. And since it's the most credit-worthy, it's going to generate the lowest interest rate. And so that's the advantage. It's going to give you your highest credit rating. That's where your AAA is. In turn, it's going to give you your lowest overall interest cost. And it's the simplest structure, most commonly understood structure out there. Disadvantages is, you've got to, they can only be issued pursuant to a referendum. And so you got to go through that referendum process. And so if you said, hey, I want to go do this project in the next 60 to 90 days, a GO bond is not going to be the one you do because, again, you got to go through that referendum process. Intergovernmental revenue bonds. This is something that's out there very prevalent in the state. It requires a separate authority who is technically the issuer of the debt. That can be a development authority or downtown development authority that's out there. They are the ones that are issuing the debt, and then you as a city enter into a contract with that authority, that development authority. You agree to make payments, lease payments to the authority in the amount of the debt service on the bonds that they issue. Now, your obligation to make payments to this authority are actually subject to the full faith and credit and taxing power. So a lot of times it's referred as maybe a backdoor GO bond because it's still a very high credit-worthy entity, but you as the city are not the one issuing the debt. One of the development authorities is out there. And that's permitted. It's very common across the state. You actually get the same credit rating as a general obligation bond because your payments to the authority are secured by the full faith, credit, and taxing power. So the underlying security is still the same. That said, it comes with a slightly higher interest rate because it reads as a revenue bond instead of a general obligation bond. And so that does affect the liquidity, the trading liquidity for underwriters and traders out there. And so that comes at a slightly higher interest rate, approximately 0.15%. Another advantage is you don't have to go through a referendum to issue that debt. You can just go through the normal city council approval process. It's, like I said, very common structure in South Carolina, in Georgia, and easily understood. And then it doesn't eat into, I'll touch on that in a second, comparing options here. Disadvantage, you have to have an authority that can issue the debt. That authority has to have the ability to finance projects within their legal guidelines. And so you can't just say, well, I have an authority, they'll go and do this project somewhere over here. It's got to be within their guidelines in terms of the projects that they can finance. And again, you've got to have the authority either created statutorily or under the Constitution. So that can sometimes make it very clear that you can fund a project this way or that you can't fund a project this way. So it's not a kind of one size fits all. It really goes to, well, do we have the authority in place? Is it already created under their guidelines? Can they finance this type of project? Revenue bonds. Think of this as, again, water and sewer and solid waste are two very relevant examples for the city there. This is where you're not pledging your full faith, credit, and taxing power, you are pledging an identified revenue stream. So water and sewer, you are pledging your water and sewer revenues, solid waste revenues, so a specific revenue stream. There is no backstop of the taxing power pledge. It's a standalone revenue bond pledge. It does not require voter approval, and again, no pledge of the taxing power there. Very straightforward, common structure. With revenue bonds, you normally have ongoing covenants. You're going to tell the lender or bondholder that you will raise rates to whatever level necessary going forward to pay the debt service. So that's their protection, is that you commit to raise the rates to cover that. And with the revenue bond structure, very straightforward. The rating, credit rating, and the interest rate is entirely dependent on the strength of the revenue pledge. If it's a really strong water and sewer pledge where you have a high coverage level, revenues over debt service, you may get a really strong credit rating. There are AAA water and sewer entities out there that are revenue bond pledges. So it can be really strong. It can also be, a much lower credit rating if your revenue pledge is not incredibly strong. Disadvantages, again, it's only available for revenue producing systems or projects that are out there. Those ongoing covenants are something that you have to live with on a going forward basis, so you have to be prepared for that. And then again, that rating and interest rate is dependent on the strength of the revenue pledge. This last category here, in terms of this catch-all category that I have, this is where you are really providing a security interest or a lien on the asset you're financing. You're providing collateral. So if you don't pay that debt, you can lose the asset you're financing there. Doesn't require a referendum. It's only available for certain types of projects. It's got to be your physical, tangible assets, your bricks and mortar type of projects, or your capital leases, because you need that collateral to secure the financing. It's going to come with typically a lower credit rating and a slightly higher interest rate as well. I said the last one, but I forgot. Tax allocation bonds. Again, you can issue those, and they're going to be secured entirely by the incremental tax revenues that are generated in a specific tax allocation district. And so we do see some of those across the state. We did one for Duluth last year. They had a really strong tax allocation district that was generating a good increment. Yes, sir?
Can you remind me, tax allocation districts, those are the ones that are just mandatory, or those are the ones where the businesses or property owners are opting in optionally?
So tax allocation districts, you all would create a specific district out there. Properties in that district at a given point in time, the values are frozen. When you create it, the values are frozen. As properties redeveloped, property values grow, it's going to generate additional tax dollars that are coming in there, and then you all have committed when you created that district to use the tax dollars to do more infrastructure, streets, sidewalks.
Okay, so then in that case, so for the landowner or business, et cetera, there's no additional tax that they're paying. So from their standpoint, same amount either way. It's just the question is, what is that tax being allocated to?
That's right. Yeah.
Thank you.
The city's using those revenues to help spur development in a specific area.
It's a great question, Councilman Palermo. Is this what's more typically known as overlays? Are these overlays?
I don't know if I...
Mike, is that where you're going with this?
No, so I was just wanting to make sure I completely understood a TAD and the difference compared to a CID, for example. Yeah.
Where there's maybe an assessment or something additional that
Right,
the business owners are paying.
exactly.
Let me pause there. I've got a couple other slides here on just general debt issuance process and things to consider. But any questions on different financing options that are out there? So when you all go to issue debt, a couple other things to consider. There's a few different marketplaces to issue the debt in. You can go and issue debt in what's called the public market. Y'all have done that before with your 2013 and 2014 general obligation bonds. That is where you go and get a credit rating. You then sell the bonds to an underwriter. An underwriter, a bank, purchases the bonds and sells them to a variety of different investors. Your mutual funds, your banks, your insurance companies, individuals. And so that's the public market that's out there. That requires an offering document. It's called an official statement, where you put in a lot of information on the city, top taxpayers, employers, things like that. And then you have what's called the bank market or a bank placement. That is where you can sell the same type of bond, but you're selling it directly to a bank. And so the bank's going to come in, they're going to be your single bond holder. You don't have to get a credit rating. You don't have to prepare an offering document. And so those options, those are the two main options that are out there. And then you have what I would call kind of the third grouping, other lenders, very much like a bank, but GEFA, Georgia Environmental Finance Authority. That's a state-created entity that has a bucket of money that they lend. If you think back to that first page we went through on your debt, you have a couple of GEFA loans out there. Very attractive interest rates, but they don't provide funding for every type of project. It's project-specific. You have Georgia Municipal Association, GMA. They also lend money. So that's, again, very similar to a bank. They're your single lender or bondholder, but it is, again, kind of the third option that's out there. When you compare those, it is not always the same answer each time. It really depends on the type of deal you're doing. But with public sales, your upfront cost, your legal fees, your financial advisor fees are going to be higher just because there's more work involved with the public market issuance. Same thing from a staff time commitment side. With that offering document, that disclosure document, that takes a lot of work to put that together. That credit rating and public disclosure, if you do a public sale, you have to commit to providing ongoing disclosure. Each year you've got to provide the market with your audit and other operating data that's out there. So you may stop there and say, why would I ever do a public sale over a bank placement? A lot of it is interest rate driven. Like right now in the public market, interest rates are a little bit lower than a bank place deal for a lot of the credits. But this is a big one, the maximum fixed term likely. Banks will lend you money on a fixed rate basis for 15 to maybe 20 years. There's a handful of banks that will lend you money on a fixed rate basis for 20 years. In the public market, you can go 30 years. We did a 40-year deal for a Georgia entity last year. So you can go really long-term fixed rate debt. So in a lot of cases, this drives the decision. If we want to do a little short-term 5-year lease, clearly that's a bank place deal. If you want to do a 30-year water and sewer revenue bond, that's going to be a public market sale. So a lot of it's just dependent on the term. You have a lot of flexibility in the public market to customize it as you want. Banks may be a little bit more particular, and then your covenants are going to be very similar. There's two types. If you go the public market route, there's two types of bond sale methods you can go. One is called competitive, and one is called negotiated. Competitive is where you just put your general obligation bond, for instance, out to bid. All the underwriters can bid on your bonds. Lowest interest cost wins. Negotiated is where you may pick your underwriter first, and then you work with them to sell your bonds. And again, you may say, well, why would I ever do negotiated if I can do competitive and lowest cost wins? Well, it really depends on a couple of things. What type of financing are you doing? What's your credit rating strength? How plain vanilla of the deal is it? For City of Roswell, for instance, if you're doing general obligation bonds, you're AAA rated, GO bonds are very straightforward. 9 out of 10 times you're going to do a competitive sale. If you're doing a certificates of participation deal or something, a tax allocation deal that's got a little bit more hair on it, a little bit of a story behind it, you may want to make sure you've got a buyer up front, you've got your underwriter early on, and so you go the negotiated route. And so it really depends on the type of deal you're doing, your characteristics, as well as the financing characteristics. In terms of the bond issuance process, if you all elect to fund something with debt and go through a financing, what are the different steps that are out there? Once you say, yes, let's do this financing, let's say, again, for instance, you put a referendum out to voters, it gets approved, and you say, well, let's do a general obligation bond there. Let's go through that process. It generally takes about 90 days from start to finish. During that 90-day period, if there are any other city council approvals, we're getting that in place. There are certain bond documents that have to be drafted. That disclosure document that I referenced, the official statement, has to get drafted. You get your credit ratings and you sell the bonds. And so general rule of thumb, 90 days for financing. It can certainly be on the shorter end if it's a little bit more straightforward. If it's a more complicated tax allocation district type bond, it may take 120 days. but 90 days is a good rule of thumb that's out there. One thing to keep in mind when you go to issue debt, there's a tax rule that's out there that says that you have to, when you close on a bond deal, you have to have the reasonable expectation that you will spend 85% of the bond proceeds within 3 years. And the rationale behind that is they don't want you to go borrow a bunch of money at a tax exempt rate and potentially invest it at a higher rate and earn what's called arbitrage. They want to know that you need the money that you're borrowing, and so they put this spending regulation in place. That said, if you end up, the project gets delayed during construction and it takes longer, that's okay. You just have to start tracking your interest earnings to make sure you're not earning any arbitrage that's out there. But this is something to keep in mind when you say, let's go to the market, let's borrow money. Well, make sure these are projects that you're going to be able to spend, or money you're going to be able to spend in the next 2 to 3 years. I want to kind of quickly mention something that's out there here, because I know I'm running low on time. Capital planning, I've referenced a couple times a model that's out there. We've got a model with the city. We built this model back in 2019 when we were first hired. We very unoriginally called it our capital planning model, but it's taking a lot of the information that I've talked about today. It's taking your existing debt, it's got your credit profile loaded up, it's got your historical financial performance, as well as projections of the capability to do projections out there, and then what we call either your formal capital improvement plan or just simply a wish list of projects. We are putting all of that information in, and then we're looking at things like, well, what's my millage impact? What's my property tax impact? What's my revenue impact? How do my fund balances look? What are my future revenue and expenditure performance? Am I complying with my financial policies and targets? How do I look from a credit rating perspective or a peer comparison? All of these things are built under one model, and so when you're making decisions like, let's fund the project this way, it's going to flow through everything. It's a very dynamic, interactive model where you turn things on and off, you change the amounts, and you can see how it affects all those things on the right-hand side, and so you have everything under one roof, and you can answer your questions. If we do everything with cash, am I still able to meet my financial fund balance policy? What do I look like from a credit rating side? Do I have the potential for a downgrade there? How do I stack up to my peers? And so all of that is built into this model, and we update it each year. Once you have a new audit, we're dropping in your audited financials. We're looking at your budget and have the ability to, again, project out going forward. Won't go through all this other than to say, here are screenshots. I just want to kind of put this tool out there. This is something that Ryan is very familiar with. And so going forward, if you ask him for scenarios and he comes back and say the millage impact would be this, here's what our fund balance would look like, here's how we compare, likely it's coming from this model because this is what it's designed for, to answer those sort of what-if type questions, run a bunch of different scenarios quickly and easily, and see what the impact is. So we can put in the type of project or bond issue. A lot of these have drop-down boxes that you can't see in our screenshots here. But what fund is it coming out of? Is it your debt service fund, general obligation bonds? Is it your general fund, water fund, et cetera? If it's debt, what are my debt assumptions? Am I going to repay it over 20 years? What's my interest rate? You put all of that information in, and then, again, these are all screenshots from the model. What does my debt service look like? What's my millage impact look like? My fund balance on the right-hand side. What does it do to my credit rating? We have a really neat feature in the model where it shows you where your credit rating is in a given year, and then we can project out a couple of years later once the debt comes on, and this tachometer will move up or down and tell you, do you have some upside opportunity? Do you have some downside risk you need to guard against if you follow this funding plan? But again, it's all tied together to if you have something turned on or off or how you're funding these projects. And this is all not expecting you to look at these numbers. I just want to kind of give you screenshots and let you know what's out there as well. But again, tax rate impact, you can look at it on the operating side too. What if we increase our operating millage to cover increasing expenditures? How does that look on a projection basis there? Your different ratios, these are all coming from your different funds. What does our fund look like? It may red flag in a given year if it's below a desired balance or below a fund balance policy. From a revenue standpoint, water and sewer fund, solid waste fund, we're looking at things, days cash on hand, basically converting your fund balance to a certain number of days of that it covers operating expenses. debt service coverage, that's a financial metric we focus on with revenue bonds. That is your revenues less expenses divided by debt service. So we look at that for your two enterprise funds, water, sewer, and solid waste. Long-term projections for all your different funds, revenues and expenditures that are out there, different growth rate assumptions. And this is where we went through, this is built into the model, this is what we pulled it from. What's your peer group out there, so we can set that. Where are you in a given year right now? Where are you in a projected year for whatever year we turn on? So this is where that data came from earlier in the slide deck. Those are the different rating tachometers. Here's where you are in a given year. What if you follow this funding plan in the future? How does that impact your credit ratings? Then last slide. So I know I went through that really quickly because I'm running out of time here, but it's really an introduction of the tool that's out there that you have at your disposal to look at different funding scenarios. Last thing to leave you with here is a specific example. So, and again, this was run in the model here. Wanted to give you an idea what it would look like if you issued a certain amount of debt, and this is just for illustrative purposes here. If you all increased your debt service millage from 0.1 to 0.5 in fiscal year 2024, how much could you fund if you issued a 20-year general obligation bond? That's the scenario I loaded up in the model. And the answer is about $45 million. So if you issued a $45 million general obligation bond in fiscal year 2023, such that it started paying debt service the following year, you pay generally the year after you issue. So this is showing you in teal, this is your current general obligation bond debt service structure. We're going to then stack on $45 million of debt. You'll see that it would cost you about $3 million per year if you did it over a 20-year period at an estimated interest rate of 2.5%. I will tell you right now, if you did it, it'd be about a 2% rate. If you did it about a month ago, it'd be about a 1.5 or 1.6% rate. We've really seen rates jump up to start the year. But this is taking into account your value of the mill, some growth in that value of the mill as well. And this basically shows you that you can, with your that half a mil growing at 2%, that is enough to cover that $3 million per year going forward. And so we can run an infinite number of scenarios here. If you tell us amounts, when you'd want to issue these, maybe you back into it and say, well, what if we want to target a certain millage impact? We can look at that as well. But we're tracking to make sure you have enough revenues coming in. Just like what has happened over the last 10 years, if you don't issue any other debt, you start to build up a little bit of a balance there that you can flush out years down the road. So wanted to leave you with a specific example just to give you some idea, provide some context of how much you could issue under a certain scenario. Yes?
You hit right on what I was thinking. With rates are set to go up between 3 and 5 different increments this next year, based off of the news that was coming out today. If we have a list of things that we would like to get done, would it not be in the best interest of everybody to get on that now? Lock this in, get going on this?
Yeah, so that's a question I've been answering a lot this month because we've seen rates jump up, primarily inflation driven. The anticipation of the Fed very soon increasing its, they just met last week. Anticipation is they'll increase for the first time in a couple of years their short-term rate at their meeting in March, and then probably have 2 to 3 to maybe 4 other increases during the course of the year. So we've seen rates start to go up in anticipation of that. And so a lot of entities are saying, do we go ahead and lock in now? Rates are rising. And I would say my general response has been, if you know the projects you want to fund and you know the amount you need to borrow, then yes, I would take today's rate over a rate a year from now. That said, that alone, I would not let drive your decision if you're not exactly sure how much you need to borrow or when you need the money. Kind of going back to that tax question I raised or a point I raised, you got to be able to have an expectation that you'll spend 85% within 3 years. So you wouldn't borrow now for a project you may not need for 2 or 3 years. But it also, a real life example that's coming up some over the last month or so, these some entities have projects to fund, but they're waiting to see if they can get federal dollars for it. Well, you don't want to go and issue debt today, lock yourself into a long-term repayment and potentially not have the ability to prepay if you think 3 months from now, you might get federal funding to pay for that project. And so that may be a reason that you say, all right, interest rates may be going up, but I need to wait to see if I really need the money. Maybe you're in the position where it's a single project and you need to bid it out. You're going to bid it out from a construction standpoint. And so if you've issued debt today for what you thought it was going to be, and you locked into that, but then you go and bid it out, prices keep going up, and you realize, well, I undershot the amount I needed. I needed another $5 million. That means you need to go and find that other funding source. And so there are certain reasons where I'd say let the project timing drive it. But in isolation, if you knew what you needed and you had a pretty good feel for the amount, yes, I'd rather lock in rates today, because the thought is rates are going to keep going up. I think most will say that most economists out there see rates going up on the short end of the yield curve faster than longer term rates. And that's because the Fed funds rate is a short-term rate. And so you'll see a flattening of the yield curve where, the cost of 3 or 5 year money may not be dramatically different than the cost of 15 or 20 year money, that flattening of the yield curve. And so that's the expectation that's out there. So long-term rates rising, but not rising as fast as short-term rates.
David, I have a question. I failed to ask this earlier. When you were showing us the different leverage instruments, I assumed that you could prepay those off, but I just heard in your comments that perhaps that there is some exclusionary value, that you cannot necessarily prepay all leverage instruments?
It depends. Everything will have a prepayment option, but it depends on the market. Going back to that public market and bank market, if you sell a bond or loan directly to a bank, you can negotiate your prepayment. A lot of banks will provide you prepayment flexibility right out of the gate. Maybe it's for free, maybe it comes at a cost for that. In the public market, though, the general prepayment provision is that after 10 years, you can prepay the debt. Before 10 years, you cannot. You can shorten that. We've done deals with 5-year or 7-year prepayment, but normally in a public market deal, there's going to be some period of time where you can't prepay the debt. And so that's the case actually with your, all the way back to the first page, your general obligation bonds. You sold those as 10-year bonds back in 2013 and 2014. And I have this call provision section in here.
Yep.
Since those were 10-year bonds at the time, and the traditional method in the public market is a 10-year no call period, those are actually not callable, so you can't prepay those. Let me say that a different way. You can prepay them, but you still owe all the interest to maturity on those.
Just as educate me a little bit. Obviously, your cost of money's been, you've got this great blend, this fantastic blend that you built in historically. You've got some small capital stuff out there. Most of that small capital stuff looks like it's around 2.5. You, of course, got these non-callable 1 at 2, 1 at 3. But I'm just curious from a standpoint, and there's been a little bit of excess cash, and I know we're hedging a little bit, but obviously we're going to start paying, the cost of money is going to be 2, 2.5, perhaps higher. But some of that short-term stuff, would it not be advantageous to knock it out? I know even though historically that's very low, very cheap, but I'm just curious, particularly if the instruments are going to bring higher, the money's going to get more expensive here.
Right. Yeah, and that's a very common question that comes up. If you have a lot of cash, do I go ahead and pay off some of this debt, maybe in anticipation of other debt to come? I tend to fall on the side of maintaining your cash just because it gives you a lot of flexibility going forward, because you never know when a project may come up and you wish you had that cash back. I also look at very low cost of debt here, and in the current environment, where it seems like short-term rates are going to start going up pretty quickly, kind of where we were a little more than 2 years ago pre-pandemic, the earnings rate, Ryan, on your cash was getting up north of 2%. I think the Georgia fund was probably north of 2%. And so we're going to start kind of getting into where you actually may start earning something again on that cash. And so I would, again, kind of in personal view here, is I like having the cash. I'm going to start earning a little bit more. Now, again, we've been in such a low short-term rate environment where you've been earning really next to nothing on that. And so that may have been a time where you say, all right, well, let me go ahead and pay some of that off. But that's a really tough question, and it just depends on how much do you value your cash and the flexibility that comes with it.
That's a great point. Are you at the end of your presentation?
Yes.
So, council, any more questions for David Cheatwood?
While you're on that slide, based off of what Mayor Wilson was saying, looking at this unassigned fund balances percentage of revenues, he's talking about potentially paying some of this stuff off. Based off of my math, you got 32%, 25 is your minimum that you like to maintain. It's 7.2% right there. Cut it in half. Let's get rid of some of the capital leases.
Again, certainly could. That's an option. I think if you looked at the amount of interest you're paying on these, given the relatively small size, it's a very minimal amount of interest that you're paying on those in terms of that's obviously what you're saving by paying those off. And it really just boils down to where do you want your fund balance? I know we have that minimum policy that's out there, but kind of going back to your peers and the credit rating as well, do you want to keep it a little bit higher than your minimum to keep you in line with that? But that's something that's out there. I will say you have a number of capital leases, but very, very common to have those with the rolling stock type, the vehicles and equipment out there. These are all, you'll see, very short-term type financings that are out there. A lot of them are 5 years. And so that tends to work out well where you have maybe, again, certain vehicles every 5 years you're doing that kind of that rolling stock again, and it works well that way. That's something, again, I'll defer to Ryan too on some of that. But it gets back to what level are you comfortable with? Do you like to have a little cushion over that minimum?
This question may be for Ryan or for both of you. With the new lease accounting standard, is that going to have any impact in the way that we reflect our financials that would influence any of our decisions?
So yes, if you see the footnote at the bottom there, that actually doesn't include the leases that we participate in through Enterprise when we lease our fleet today. So with that, the new accounting standard, that appears in our audit as debt. I don't know, David can answer the question, with the rating agencies, did they take that into account when they're looking?
So I don't think historically they have not. It's a good question of whether they will start doing that, but there's, that's a good question. I don't know the answer to that. A lot of them are on the smaller side, and so I don't think it's going to move the needle either way if they start incorporating that. But that's a good question whether they will start adding that in or not. Yeah.
Council, any more questions for Mr. Cheatwood? David Cheatwood, Managing Director of First Tyrant Advisors, the City of Roswell, thanks you for your presentation. We thank you for your service to our city for the last couple of years. We're glad you're a part of us. Thank you.
Thanks a lot. Thanks for having me.
Mr. Luckett, I believe you now take over the next part of the presentation.
Yes, before we go to the next presentation, I did have a few just closing comments I wanted to point out to you all.
On capital funding discussion.
Yes.
Yes, sir.
And so first, just a few points. Wanted to mention kind of capital projects and how those factor into our annual budget process. We're going through the annual budget process right now, and the way it works is that departments are submitting their capital project needs as part of the annual budget process for your consideration. And really, there's two components here. We're talking about the capital budget as well as the 5-year capital improvement program. The capital budget really just includes funding for the current or the upcoming fiscal year for those capital items. So we may have a $10 million building that we're building, but we only need $2 million appropriated in that first year. That's what you'll see in the capital budget, and that's what will be before you a few months from now when you're deciding on the annual budget. The 5-year capital improvement program is something that we bring to you every year through the annual budget process. And it includes that first year, the capital budget, but it also includes an additional 4 years of projects that we know are on the horizon. You can see here I put that the plan is approved by Mayor and Council, and it should outline the capital project plans for the next 5 years that can be realistically funded through available sources. We do this today, but it's something that we're also aspiring to improve upon in terms of today the CIP is more like a wish list. It hasn't been really gone through a careful, deliberative process of here's what we anticipate in available funding, and we're only going to put those things in there that we know or have a reasonable expectation that we'll have the funding for. So that's something that we as staff are working to improve upon, to bring to you so for your consideration, to have a document that we can rely on a little bit more going forward in terms of what can be funded the next 5 years.
Can I just tell you something? Thank you. That's fantastic self-awareness. I mean, I really appreciate that. I can tell you, as a citizen and as an elected official, I really appreciate that distinction, and I think that matters. And to your point, Mr. Knight, we can't be doing that enough. We cannot be outlining with greater clarity our potential future expenditures and making that clear, not only to ourselves, but to our fellow residents. So I'm really glad you touched on that and made a very clear distinction about that with respect to capital projects. So thank you for doing that. Is that the end of the capital funding discussion?
2 more slides, I think.
2 more slides, okay.
We're almost there. In terms of referendums, I did want to point out a few other guidelines that we have to take into consideration. First of all, the eligible election dates are something that are set by the state. And as part of our process as a city, you all would have to approve a bond referendum resolution to kind of kick that process off to hold a referendum. The deadline for final city council approval, and that when I say final city council approval, this is to have a referendum, and that includes knowing what projects we're doing as well as the amounts. This is the timeline here. So in this is a state thing, it's not us, even number election years, it takes about 100 days prior to the election that we need to have everything ready and figured out and ready to go. In odd number election years, we have 70 days prior to the election where everything has to be decided and ready to go. And I'll show you kind of what that looks like on this next slide. So in 2022, there are 2 opportunities for a referendum. One is the state primary in May. One is the general election in November. Our deadline for May has already passed. So really, if we're looking at something this year, it would be November, and we would have to have everything ready and decided by July 2022. And you can see kind of how that stacks up in the future years. And that was the last slide.
Well, on that very bad news that you just delivered, no, that's very helpful. To your point, today's January 31st. I don't think the council will be presenting anything to you today. Mr. Knight, anything you want to finish on the capital funding discussion to add to this?
No, I certainly appreciate Mr. Cheatwood with first try on and going over a very detailed presentation, and there still are options out there in terms of capital funding per the mayor and council's consideration and ultimate approval. Thank you for outlining those, and we appreciate the report, and I'm sure we'll be having some additional conversations with you probably in the near future.
Thanks so much for being with us. I know it's a lot of fun to come into these kind of settings and stand up there for an hour and take cheap shots, but thank you for doing it.
It's the time of year, this is budget time.
It is budget time. So with no further ado, and please feel free to stay with us. You don't have to leave us, but I think we jump into the ARPA funds discussion.
Yes.
And Ryan, I believe you're going to lead us in that discussion. Are you not, sir?
Yes, sir. So yes, we are here this evening also to talk about the ARPA funds. As of a couple of weeks ago, we received the final rules from the U.S. Treasury Department on how those funds can be spent. Not a lot of changes from what we already knew, but a few tweaks here and there. So today we wanted to go over with you just an overview of what the funds, the basic guidelines of the funds, a review of eligible uses, review the community survey results, and just talk about a few next steps and answer any questions or any discussion that you all might have. Just to recap, and we've talked about this a couple different times, but the state and local fiscal recovery funds, that was a component of the American Rescue Plan Act. It was provided $350 billion that were allocated for state and local governments within the state of Georgia, the state received about $4.8 billion. Fulton County received about $206 million. And as you know, we as the city of Roswell received $11.3 million. I've listed on here also, these were funding objectives that were provided by the U.S. Treasury, what they would like to see the funds spent on. And that includes supporting COVID-19 response efforts, replacing lost revenue for state and local governments, stabilizing economically households and businesses, and addressing the public health and economic challenges that have contributed to the unequal impact of the pandemic. Just to provide a little bit of background, so as I mentioned, the U.S. Treasury Department provided their final rule back on January 6th of this year. It was about 400 pages of information, and like I said, not a lot of changes that they provided. Some of the uses were expanded. They reorganized some of the different uses that we had available to us. And basically what I want to say here is that the city does have flexibility. We're not tied down to using just one or multiple of the categories eligible uses, but we're able to use the funds that in a way that best meet the needs of the community within the eligible use guidelines. The U.S. Treasury Department also urged local governments to engage the community in developing plans to use the funds. One thing I also will say here is that the eligible uses that you'll see in the presentation are really meant to provide kind of like a high-level understanding of what the rules are. For very specific programs, we might need some additional time to look at those. I will say, and the U.S. Treasury Department has also pointed this out, that using the revenue loss category as a way to expend the funds is kind of our least complicated and most flexible category we have available. And for us here in the city, our full allocation qualifies for the lost revenue category. So it provides us with a lot of flexibility, and I'll touch on that in just a moment, what that looks like. Basically, through the rules of Arpa, there are 4 uses. One is to respond to the public health emergency or its negative economic impacts. Second, to respond to workers performing essential work during the public health emergency by providing premium pay. Third, the provision of government services to the extent of revenue loss that we experience. And then finally, to make necessary investments in water, sewer, and broadband infrastructure. First, I'll cover public health and economic impacts. Here, the key thing to remember is that our eligible use must respond to the disease itself or the harmful consequence of the economic disruptions resulting from COVID. So there's a requirement to identify the need or the negative impact and then identify how the program itself will address that need or impact. So when it comes to public health uses, there's a few different categories that they provide. One is COVID mitigation and prevention. This is a non-exclusive list, but it's some of the specific uses that the U.S. Treasury Department has outlined. So for instance, vaccination programs and incentives, testing, contact tracing, and I won't name all these, but a lot of things that are specifically responding to the public health needs that may exist. Next includes medical expenses and behavioral health care associated with the pandemic. And then finally, preventing and responding to increased violence resulting from the public health emergency. So those are the ones that fall within sort of the public health use. Getting into the negative economic impacts component, here the eligible use must be designed to address an economic harm, and they must be related and reasonably proportional to the harm that was experienced. Something new that was included in the final rule was this distinction between impacted versus disproportionately impacted. And so there are certain services or certain uses that can be provided to all impacted communities or individuals. And then there are certain services or programs that can be provided to disproportionately impacted individuals. The main difference here, just to give you a couple of examples, on the impacted side, that would be really the general public when it comes to the public health emergency, but it could also include people who experience unemployment. On the disproportionately impacted side, that could include individuals living in a qualified census tract, low-income individuals, those that qualify for the free and reduced lunch program through the schools. So in terms of negative economic impacts, there's a few different categories. One is the assistance to impacted households. And I'll call out a few of the examples listed here: food assistance, emergency housing assistance, which the city has done previously through the North Fulton Community Charities, providing rent, mortgage, and utility assistance. It also includes internet access and digital literacy, including subsidies, where we're helping those who can't afford it obtain internet services. It also includes, I'll call it here, the last one there, development, repair, and operation of affordable housing and services to increase long-term housing security. I know that's been a discussion point, and that is an eligible use under this category. Negative economic impacts are related to disproportionately impacted households. These are the additional services that can be provided to these populations. So that includes community health workers, lead paint remediation, housing vouchers, improvement to vacant and abandoned properties, and a few other items listed there. Next, we include assistance to impacted small businesses, and these can include basically loans or grants to small businesses, which the city has done some over the last year. Disproportionately impacted small businesses, it expands the use to include rehabilitating commercial properties, facade improvements, support for micro businesses. The next category addresses assistance to impacted nonprofits, and this includes loans or grants to mitigate financial hardship. And then when it comes to disproportionately impacted nonprofits, the guidance really was just assistance that's related and reasonably proportional. And then finally, under this category of negative economic impacts, it also specifies aid to impacted industries, and specifically the rules call out travel, tourism, and hospitality industries. And the options that we have to provide there include basically helping them mitigate whatever financial hardship they encountered through being closed during the pandemic. And then finally, the other use, this is something new that was in the final rule, was restoring or bolstering public sector capacity, meaning employment, whether it's public safety or just public sector employees in general. I will point out that we can do the same thing through the revenue loss category if that was something the mayor and council were interested in pursuing. The next category included premium pay for essential work. Essential work is really in-person interactions or regular physical handling. An eligible worker is someone that was needed to maintain continuity of operations for essential critical infrastructure sectors. The guidelines really are, this can include both public and private sector employees that are essential workers. Premium pay is up to $13 per hour in additional wages. It can be provided retrospectively or prospectively, and it should prioritize compensation for lower income eligible workers. The next category covers the city's revenue loss, and we are allowed to make up some of the lost revenue that we experienced during the pandemic. The guidance really addresses that we are only able to include general revenues as defined by the Census Bureau, and basically that includes most of our revenues with a few exceptions that I've listed there. The revenue loss formula was provided by the U.S. Treasury Department, so we have an exact formula that we have to follow in calculating that. And basically it compares 18 months from July 1st, 2019 through December of 2020 to the prior fiscal year. And there's a growth rate that we're allowed to factor in. And so based on that formula, the city's entire Arpa allocation is eligible for use under the revenue loss category. So how can the funds be used under this category? The rules are basically that the funds can be used for the provision of government services. So it's pretty general. Basically, it covers anything that a government typically would provide in terms of services. Some specific examples that the Treasury Department provided included maintenance or pay-go building of infrastructure, modernization of cybersecurity, health services, environmental remediation, public safety services. But again, pretty much anything that we do as a city falls under this category. The only things that are excluded here would be debt, legal settlements, or replenishing reserve funds. They specifically mention that those are not eligible items. The The last category includes water and sewer and broadband infrastructure. So here, the projects are intended to improve access to clean drinking water, improve wastewater and stormwater systems, and high-quality broadband. The basic guidance here is that the projects that we would, if we decided to pursue projects under this category, they would need to be aligned with the EPA Clean Water and Drinking Water State Revolving Funds. But pretty much any infrastructure program from our water or sewer or stormwater funds, most of those will qualify under this category. Other guidance, the funds cannot be used for pension funds, non-federal match for other federal programs, reserve funds, or legal settlements. All of our uses of the funds are subject to requirements for federal awards, audit requirements. Timing-wise, we must have the funds obligated, so we have to have these decided by December 2024. And we have until December of 2026 to actually finish spending the funds. We as a city have reporting requirements. One of those was today, the last day those were due, and we completed that reporting requirement just a few days ago. Just to wrap up this portion, these are some principles, and we mentioned these before in terms of spending these funds. We would discourage using the funds since they're non-recurring, using those for recurring items, looking to leverage potential partnerships where we can, taking advantage of other dedicated grants and programs first when possible. And then just something to keep in mind is that we have to comply with the regulations and use them in a way that contributes to our long-term fiscal stability. So that covers all of the eligible uses. Next are the community survey results. So here, earlier, back in August, I believe it was, the Mayor and Council directed staff to obtain some feedback from the community regarding the use of ARPA funds. A website or site was added to the city's webpage to provide that basic information. We also opened up a survey from December 10th through the 24th. Also publicized that. This is a list of all of the ways that the survey was publicized, provided by community relations. So social media was in the newspaper, various newspapers, various postings across that time period. The goal of the survey was to obtain resident feedback as to the relative importance of the various eligible uses. We did do our best to provide some context for each of the questions. Just as an example, talking about the public health use, for instance, just letting people know that typically those services are not provided by the city, but Fulton County. We try to provide that context for each of the questions. We received about 1,000 individuals that accessed the survey. Around 850 of those provided feedback on each of the eligible uses. This is just a one-screen snapshot of the results of the survey. So you can see at the bottom that darkest color shows you the percentage of respondents and that rated that particular category as very important. So you can see here that the highest scoring level from a very important standpoint were the city services or projects category, using that revenue loss category. Other highly rated ones, the premium pay for essential workers and some of the various assistance programs. Looking at it a different way, if we take a weighted average, you can see that, again, the city services and capital projects rated highest. Premium pay was next, and then the other three were kind of around the same ballpark area: financial assistance to small businesses, residents, and nonprofit organizations. And then finally, we gave people the opportunity to provide comments. This is just a word cloud kind of representing the prominence of various words and phrases that were seen in the comments. You can see some of the largest ones: businesses, sidewalks, COVID, infrastructure, probably small businesses, recreation, people. So just to give you an idea, the actual detail of the results are provided in your packet, and I think have been provided previously as well. Next steps, again, we're willing to answer any questions, any discussion that you all may have. In terms of actually deciding on making spending decisions regarding the ARPA funds. That could be included as part of the budget process that we're going through now. It could be a totally separate decision that's up to the will of the mayor and council. So with that, that's the conclusion of the presentation. I'll be glad to answer any questions.
Ryan, thank you. Well done, sir. A quick, just a side question. On the community results, the 850 respondents, how many of those were Roswell residents?
Those were, I believe, all of the 850 were Roswell residents.
Were you able to determine that with clarity?
Yes, that was one of the questions. The first question they answered was whether or not you were a Roswell resident. So if they responded truthfully, then all 850 of those responses should have been Roswell residents.
Okay, great, thank you. So, thanks for the great presentation. Councilmember Hall, I'm calling you this, we're gonna cut Lee out this, and we'll give you first dibs.
Thank you. Thank you. Great presentation, Ryan. And
Thank you.
I swim in this lane with you on ARPA. Just a couple of, one clarification point and a question. Probably in the survey, it wasn't put out to the folks. Did we contribute $1 million from another previous COVID or a CARES Act funding to premium pay for essential workers? Did we approve $1 million?
It was a one-time compensation for all city employees.
Okay, for
it wasn't
the,
necessarily targeted to what this would consider essential, but it was across the board.
so we did $1 million across the board for, because the people work through COVID and to recognize them. Okay, thank you. And then the other thing I wanted to clarify, and I know it's hard to wrap your head around sometimes because they're giving us the option to do this formula for the revenue loss. The city actually was over budget during these years of pandemic and COVID. It's just that there's a formula that when you do the formula, the math works where we can take these $11.3 million and put it in the general fund under that formula. And from an operations perspective, would that be the preferential method from staff and then kind of disperse it from there because you're only accounting once to the government on that? Can you speak to that a little bit?
Sure. You're right. The city, we took a lot of proactive steps in the beginning to make sure we weren't going to go over budget, to make sure we were operating within what we thought could be a worst case scenario. We did see a reduction in revenue, but you're right in that there was a formula that included a lot of other factors that we were able to include that took us to, over that 18-month period, the calculated revenue loss was about $20 million. Did we actually see a reduction of $20 million? No. We did see a reduction in revenue, but not to that extent. And then your other question, I think from a staff perspective and from the Treasury Department, I think in some of the guidance they provided, the revenue loss category provides the most flexibility. Even if we wanted to do items that fell in the other categories, we most likely could do those through this revenue loss category as well. So I think it provides the most flexibility and ease of reporting, and so, yes.
Thanks, Councilmember Hall. Councilmember Hill.
Yes, thank you. Just for clarification, there's no special recipe of a proportion or whatever of where we spend the money in different categories. It's just up to us to make those decisions, correct?
That's correct.
Okay.
It's a great question, by the way. Councilmember Palermo.
I think I have multiple questions and comments, and just to reiterate Councilmember Hill's, to be positive, so it could all be on one single project, or it could be spread like peanut butter to many different things, just to clarify. Thank you. And couple comments I have is one, I would prefer to not wait until the budget process for this, because ultimately I'd expect we're going to pass a budget in May. And if we are looking to take on a large project for our residents, I think we're better off getting that started and move in that direction if this council comes to an agreement and sees where there's opportunity for really investing for Roswell residents. So that's number one. Also, I appreciate that you called it out again. I definitely strongly believe, even though it's allowed to be because of the lost revenue, I strongly believe this should not be going towards, as you say, it shouldn't recurring costs. I strongly feel it should not be going to maintenance and even capital maintenance, because I do feel those are things that we should be putting into our annual budget to make sure they're paying to maintain our city. And I am hoping to see some true just investment and project and clear, net new win for residents is what I'm hoping we can discuss as a council.
Palermo, thank you for those comments and the clarity of those. Councilmember Hall, sorry.
Thank you. I just wanted to, I'm not sure if this is 100% accurate. The city of Dunwoody, they acquired land and built a park with their proceeds. And do you have any examples of what some other cities did?
We did reach out, and this is a few months old. We haven't checked recently, but when we reached out several months back to kind of see how other cities were using theirs, Dunwoody did use theirs for new park construction. Alpharetta discussed using it for recurring capital. Johns Creek, we couldn't find any information. Milton talked about a potential new project for an athletic complex. Peachtree Corners used theirs for grant programs for businesses and nonprofits, as well as city broadband, city revenue loss, a few other items. And then Sandy Springs, we weren't able to get any information on at that time. Fulton County itself, we looked at them as well. A lot of it was going to the court system for the backlog that they're seeing there, as well as some of the traditional uses that you would see at the county level: public health, emergency rental assistance, things like that.
Great question, Councilmember Hall. Councilmember Hill.
One more. I'm having a oh my gosh moment, and hopefully you can clear this up. So regarding premium pay for essential work, and we're talking about not using these funds for best practice, not using these funds for reoccurring expenses. What happens? Who's on the hook after this is paid out? Because those wages are going to be in place following.
I think the intent of it is that it's a one-time payment, or it could be for a certain defined period of time. So it could be that we go back and say, these certain groups of employees worked this many hours during the pandemic, this certain time period, and we're going to pay them this much on top. Where it could be from this time period going forward to this time period, the premium pay would be in place.
So almost like a stipend, or
It is,
a temporary,
yeah. Temporary stipend.
get you
would
over
be a
the
good way of
hump
thinking
kind of
about it.
thing? When it noted a $13 per hour or a cap of $25,000, I just thought that would be setting a precedent. So, okay, thank you.
Councilmember Mortland.
I have not read the 450-page Arpa report. Hopefully you have. But can you humor me and tell me, is there any negative to us turning the funds back over, not using them? This is free money. Is there any reason not to use the money?
Honestly, I don't remember reading that in the guidance in terms of what that looks like. So I would have to look into that a little more if we were to return the funds. Is that what you're saying?
Yeah,
Yeah.
basically, yeah.
Honestly, I'm not sure. I'd have to look into that a little more.
Across the board, it's a wise move to use the money, obviously, but just looking at it from both sides, is there any negative to turning it back over?
Yeah, I mean, from a city perspective, I think it's just the fact that, you have access to readily available funds that could be used for a variety of needs. But in terms of actually returning the funds, like I said, I'd have to look into that a little more to see what repercussions that may look like from the federal perspective.
Council, any other? Yes, sir, Councilman Vanstrom.
I just had a quick question that maybe we could get some clarity on. There was a discussion of utilizing those funds to match other available funds, grants, and those items. Could we get a review from the departments of what they may have that we could benefit from such a marriage of funds?
Sure. There's some requirements, and they may have tweaked it a little bit, but initially there was a requirement that the funds couldn't, I believe I mentioned that, the funds couldn't be used for a non-federal match for certain grants. But we can certainly take a closer look at that and see kind of what the guidelines are a little more.
Creative ideal, Councilman Vanstrom. Any other questions from the council? Thoughts, comments? Mr. Knight, would you like to add any comments, sir?
No, thank you, Mayor. And I think it's been a very robust conversation. And to follow up on that question, to Councilmember Morthland's question, and I appreciate Ryan's attention to detail and his cautious and measured response of checking to be sure. I've also been on several webinars or virtual meetings with GMA and other entities, and no one has mentioned any obligation or reason not to utilize the funds, but certainly we can take another look at that as well. I do think, obviously the intent was to help support local governments with either revenue loss or impacts of the pandemic, and therefore those funds, I feel fairly confident, can be utilized in a variety of ways, as Ryan mentioned earlier. And I'm sure we'll have further conversations about identifying specific areas where those funds should be utilized. Thank you.
Thank you, Mr. Knight. And I will tell you that I think this council and mayor have discussed the ARPA piece to some degree in the past, and we've had some say not robust discussions, but some good discussions. I really appreciate you bringing clarity to us on how the funds can be spent. I think that the council and mayor, if I can generally speak for us, agrees with the sentiment of the community and how the community wished that this money be spent on projects. And I think you'll see that come out in terms of our perspective as this discussion evolves and progresses. And thank you for your great work on this, Ryan. And obviously, you got a lot of work ahead of you. Any other thoughts or comments from you before we adjourn?
I think that's it. Thank you.
Well, with no other thoughts or comments, this meeting is adjourned and we're heading to City Council chambers. Thanks so much.